Joining me today is Canadian real estate lawyer Mark Morris. In this interview, we discuss Canada's obsession with real estate. We get into where inflation might be heading. And Mark gives us his thoughts on where he thinks Canadian housing may be heading in the relatively near term. Guys, I found Mark on various Twitter spaces. I thought he was an incredibly engaging speaker, and I was thrilled when he accepted our invitation to hop on here. So please sit down and enjoy this interview. I think it gives pretty good insights on why Canada became so obsessed with real estate and where we could be heading. All right, everybody, enjoy the interview. Mark, thanks so much for joining us today.
That's a real pleasure. Thank you. Thank you so much.
So I first stumbled across you on Twitter and thought, okay, Mark's a young entrepreneur. He's built some businesses. Really understands a lot of or shares the same views that I do in the sense of young Canadians would much rather focus on becoming a real estate agent, mortgage broker, or doing some form of commercial real estate than actually focus on, going and solving problems and doing productive things. What do you think got us to this point in Canada? And do you think we're at the point now where there could be a wrecking ball that's going to sort of maybe get us back to doing productive things?
Sure. Well, first of all, thank you for having me. Those are loaded questions. And let me just take apart every part of what you just said there, starting with young. No one has called me that for a while. I'm pushing on 50 now. So unfortunately,
oh, really? You look good for 50.
I wish I was younger. There we go.
I'm surprised to hear that. You look young. You look good for your age.
I'm all too happy for the compliment. So let's address what you said. So let's start with the systemic problem, because you have put your finger on the hammer's on the nail. We have a problem in this country, and the problem is that government policy since World War II has intentionally directed massive returns to people who engage in the real estate sector at the expense of innovative economy. So, as an example, I used to represent people in the restaurant space. And if someone, I represented a very, very, very successful restaurant, 20 years of, EBITDA and God knows what, of like 4 million per year. It's just ridiculously good numbers, like trying to compete with the keg kind of numbers, multiple locations and everything else. One day he turned to me and he said, sick of renting these places. I'm going to actually decide that I'm going to start a brand new brand. And I'm going to try to own the location and God knows what. So he said, I need $4 million for it. So he went to the bank and he said, here are my financials. And the bank said, thank you very much. What real estate do you have to pledge? And then if he was able to find financing, which he wasn't, by the way, he would have found financing. This is back in the day when interest rates were low. He would have found financing in the range of 12, 13, 14%. Meanwhile, Mark Morris, who is a ticker who can go at any single time, can't cross the street without perhaps being hit by a bus. When I decide I'm going to spend $4 million in a house, banks compete with me for the privilege to ultimately provide me with a lower rate than one another. And I'm borrowing at government or near government rates. This is a government policy. This is something where the government has said, we want to ultimately allow Canadians to borrow, because home ownership is important in our view. We're going to allow Canadians to borrow at ridiculously low rates. Moreover, when they sell, it's going to be this. And when they build, there's one other exception, but it's nowhere near as rich as this. They're not going to pay any tax when they sell. So we have a system that has been set up around the benefit of real estate ownership. And it has happened to the exclusion of the innovative economy that you sometimes see down south in the Bay Area and Austin and other areas. And for those of us who are pulling our hair out saying, well, why isn't Canada like that? It's because we have an economy that's driven towards real estate, and we're encouraged to those investments as opposed to making massive returns on riskier ventures, truly innovative ventures, because there's really nothing innovative about real estate. It's necessary. It's not innovative. And I lament that as much as you do. There was the last question you asked, which is where are we? And are we hitting this wrecking ball moment? I think that, it may have been controversial at some point in the past to say, yes, we're hitting a wrecking ball moment. But I think more and more people are internalizing that, yes, in fact, a reckoning is coming due. After all, remember, there was great deleveraging across the world in real estate that took place in 2007, 2008. And that deleveraging did not occur in exactly two countries, Canada and Australia. So if you actually take a look at the global real estate charts, it went like this, and then it went down in 2002, 2008, and then went up from there. So on balance, it was if you do the regression, it was a more balanced and gradual rise, given that you're encapsulating what was a significant fall for 2 or 3 years. Australia had a pause in the real estate market, but never really had a dip. And as a result, we've just been shooting upwards for far too long. We're vastly exceeded our income to support the debt. And, the bell tolls for thee. Eventually it comes due. And I don't think it is very hard to see that with higher interest rates, we're now creaking at the helm, and that we're not going to actually have necessarily the smooth landing that some had hoped. Certainly going to be rockier than others. I can project where I think it's going, but I think at this present time, we're already in for a rockier landing than people were hoping.
I apologize here, but I'm going to pick on the real estate influencers out there. Originally, they told us interest rates could never go up because the Bank of Canada was trapped. Then they told us that interest rates won't keep going up and the Bank of Canada is going to pivot because the Bank of Canada is trapped. Now the narrative I'm finding from going on these different Twitter spaces is, well, even if interest rates continue to stay this high or go up a little bit, it doesn't matter because Canadian real estate it effectively will keep going up because there's just so much immigration coming into the country and so many people want to live here that housing prices can't go down. So here's the question I pose for you is that if mortgage rates stay anywhere near this level, do you think that it's likely, or what do you think the probability is that housing prices can stay at this level?
So first off, not to pat myself on the back here, but if you check out my Twitter feed, I have many, many, many instances of marking 7% on a 5-year fix in January of this year. I told everyone as of December even was the first time I mentioned it. But January of this year, I said, we're going to 7% on a 5-year fix by the end of this year. I was the only one that did it. I took a lot of ridicule, but I have numerous threads on this subject, and I have never backed down from that. So that doesn't answer your question at all. That's just about making sure my ego gets inflated a little.
Well, congratulations on the call.
There you go. That's what I was looking for right there. The interesting thing for me is particularly in Twitter discourse, is how off the market is. Not that, first of all, the people who are making the projections aren't macro. They aren't macro. These aren't people who delve in macro. They're people who are affected by macro. They're people who are affected by higher interest rates. They're people who are affected and therefore have to be able to talk the talk. But they're not people who substantively deal with macro. Because if they were, they wouldn't be doing an analysis of what's happening with interest rates vis-a-vis the housing market. It's a blunt policy, interest rates. Interest rates affect the price of oil and gas. Interest rates affect the price of the dollar. Interest rates affect a whole range of things. And a true macroeconomist, someone who's really looking at this, understands that real estate is but a portion. And so when you're looking at something when you have a hammer, everything looks like a nail, right? And when you're dealing with these people who only deal with real estate, they say, well, I can't go any higher because we're going to crash. But they're not encompassing the whole picture that the Bank of Canada is looking at. And the Bank of Canada has been very, very clear that what it cares about above all else is not someone who, average Joe, has 3 houses and is now facing higher interest rates. It's inflation. It's inflation, inflation, inflation. That is all that they care about. And a true macro analysis starts from that perspective. What's interesting to me in the Twitter real estate space is how badly people appreciate what is going on. Because anyone who sits there and speaks about rates without speaking about duration and intensity does not understand the factors that are at play. It's not bad to have an interest rate of 6 or 7% on a 5-year fixed for 4 months. It is bad to have 7% on a 5-year fixed for 3 years. It is the duration of the higher interest rate that is the killer. It is not the interest rate itself. And so if we just play the guessing game that everyone is playing, those people who don't really study macro but pretend to, and ultimately say, hey, yeah, no, absolutely, we're going to hit this interest rate and then things are going to come down. Well, okay, that tells you nothing. What matters is When are we going to come down? I personally am of the opinion that we will be at higher interest rates for a while. Now, remember, in Canada, everyone, Steve, I should ask this: is the majority of your audience Canadian or American?
We sit around 70% Canadian, 30% American.
Fine. So, for the benefit of the Americans, you should know that every single Canadian who has a mortgage is on an ARM-based mortgage. There is no such thing except, by the way, it is a privilege that you guys have in the States that you are able to have your 30-year mortgage. I know you think it's normal, but it actually stems from having the reserve currency of the world, which allows people to make projections out 30 years and have confidence in those projections. Canada, I love this country, love it dearly. This is my home. I will defend it with there's so much that's good about this place, but we're not the States. We don't have a reserve currency. We don't. And because we don't have a reserve currency, we, along with every other real estate country, does not have a 30-year mortgage. We instead have a 5-year mortgage, meaning that, or a maximum 10-year mortgage. But most Canadians are working on 5-year terms. What that means is that if interest rates remain high for a while, it means that everyone is going to take a bath. Doesn't matter. I had the privilege of, I put my money where my mouth is. When I was saying 7% is coming, in January, I moved into a fixed at a low rate. But that means in 5 years, I'm going to be entering into this market too. And so if this stays high for a period of 5 years, I'm going to take my bath. But if it stays high for 3 years, that effectively means that 66% or more, whatever 3/5 is. This is why you should take math, kiddies. Whatever 3/5 is they're going to re-enter into this market, even if they're on a fixed rate mortgage, which 50% of the country is. So even those people who acted conservatively are going to be forced into this higher interest rate environment. And thus, over time, this becomes a problem. Now, to some degree, we haven't seen the problem. This is getting to your question as to where we're going in the market. We haven't seen this problem crystallize for 2 reasons so far. First, this is kind of like holding your breath underwater. Everyone was awash in great oxygen. It was like being at a casino. They were pumping oxygen into the place. Everyone had their lungs filled to capacity as of February. And then everyone collectively had their head dunked underwater. For the first 30 seconds, we're all looking around and we're perfectly fine. You start to drown after 30 seconds, and by 60 seconds, people start to die. It's a duration thing. And what's happening is that we were flush with cash as of February. And as a result, there's a lot of people who are able to ride this out for several months because they have assets. They were breathing in the oxygen for a while. Their head is underwater, but it hasn't been held underwater for a long period of time. That, in conjunction with the fact that Canada still has a very strong rental market, allowing people an option to sit on the sidelines while still having a return on the property, meaning that they can have a slow bleed for a little bit of time. But the reality of economics is such that you can only avoid that for a period of time. And now we're starting, particularly in my office, but we're expecting to see more and more of it, but it's starting to roll in. We're starting to see the trustees being needed. We're starting to see the people who can't get their tertiary mortgages after Christmas, come February. I think the blood starts flowing.
CBC just did a special, I'm sure you saw, where they said that they called 25, what they refer to as mortgage agents in various markets across Canada. And they found that 5 of the 25 demonstrated a willingness to get the person on the phone some sort of fraudulent documents to get a mortgage. How much of a problem do you think fraud is in the entire Canadian real estate ecosystem?
Well, okay. First of all, I was actually the background lawyer for that piece.
Okay.
Just FYI, so they were running it by me and verifying their
oh, really?
data. So let's not overstate it. Fraud is this isn't from me. This is from better minds than myself. Because I'm not in the mortgage space. Better minds than myself put it at about 5 or 6% of Canadian total. More than it should be. Not a huge deal, and quite frankly, blown out of proportion, because the interesting thing about mortgage fraud is those people who engage in mortgage fraud are just as likely to pay their mortgage as those people who aren't, historically, who don't. So it doesn't really have much effect outside of pushing up prices, which it definitely does, it doesn't really have much effect on the default rates. Because after all, those people who are engaging in mortgage fraud, they're still housing their families in this house. The fact that you've engaged in mortgage fraud doesn't mean that you want your kids to go homeless and that you don't want their kids to go to school.
But you more than likely weren't given an appropriate stress test, which I think was supposed to be sort of a safety net, right? So although you might be able to service that debt after interest rates go up, 400 basis points, that's when the problem kicks in.
Steve, I don't believe in. Okay, so let me say this. I'm very much in favor of the stress test. I'm thrilled the Canadian government did it. Good on them. This is one of those times where you can point to a government policy and say, you guys were forward thinking, you did it. But I'm also a father and I have 2 children, because remember, I'm pushing on 50. And as a father, I know very well that no matter how much money I earn, I'm always 1 cent away from bankruptcy. Every single cent that I have is going into investments, into kids' schooling, is going into vacations, is going into life. It is a truism in life that we are all pretty much living on the edge pretty much at all times. Now, there's obviously exceptions, right? There's your 1% and there's Nantucket and whatever else. But the vast majority of us that work for a living, that don't have inherited wealth, we are to the brink. And the very fact that we've been stress tested at 7% does not change the fundamentals of our bank account, which is, thank you very much, how am I going to pay my credit card this month? It's not like we're sitting there with $300 extra in the bank now, suddenly saying, oh, good. No, what's happening is it's gone into other things. That's the way the world works. These stresses, even though we've been stress tested, we are going to have significant problems. Frankly, to your question, if you want to point your finger at where the systemic weakness in the market is, it's not those people who have engaged in mortgage fraud. It is those people who have engaged in tertiary mortgages. Permit me to explain. So there's 3 different types of mortgages that people can pretty much get in this world. One is the Class A, TD Bank, Scotiabank, whatever it is. 2 is the B class banks, Home Trust, Street Capital, whatever it is. And those banks are good. They're pretty much like, hey, you own a business, and so we're not recognizing your income because you don't work for a big employer, but you have everything going right, so we're going to extend it to at a slightly higher rate. And then there's the privates, the thirds. Those are the privates. Now, the privates are used by people who usually have no recourse and don't have good credit or don't have the ability to actually fund with Home Trust or whatever it is. And the interesting thing about the privates is that they're overwhelmingly, not all, but many of them, are in suburban areas at the outskirts where immigrants live, where people who are first generation live, whatever it may be. And these places are, and they're lending against properties that went up fast during the boom and are falling fast now. Now, what this means, if you put it all together, is this. These privates were lending at, say, 75% LTV. So you put down 25%, they would lend at 75%. But the value of the property is now fallen 40% in Stouffville. And it's now fallen 40% in North Brampton and Caledon and whatever it is. And so these privates are saying, which are always for a 1-year basis. The privates are always usually for 6 months or 1 year. These privates are now saying, screw you, we're not renewing. We want our money back or else power of sale. And the problem is these people who didn't have a pot to piss in the first place, that's why they went to a private, they can't replicate the mortgage they had at different privates because the privates are now saying we'll only do 60% LTV because of the way the market is falling. You have to come up with that 15% difference. Those are the people where we're starting to see creeps. Those are the people we're starting to see turn to trustees. Those are the people we're starting to see say, we have problems. And these are not problems that can be solved by refinancing at higher rates. These are problems where fundamentally someone needs to take a haircut who isn't. That's what's going on right now.
Do you believe that the government made missteps by allowing these sort of private mortgages to become such a thing? Or do you think that that's just how markets work and we just need to go through those cycles?
Well, it wasn't government allowance. Anyone's allowed to lend anyone else money.
Yeah.
Right? Like that's cool. This wasn't a CMHC thing or anything else. This was the irrational exuberant. People say, so when I said that real estate markets deleverage, they don't deleverage like a balloon, right? Like when you have a big filled balloon, you let some air out, all the parts of the balloon shrink in tandem. That's not what deleveraging is. Deleveraging is very unequal. Deleveraging takes place massively in some areas, and in other areas, maybe not at all. As an example, the deleveraging that we've seen so far have been the suburban and largely outside of Toronto markets, whereas condo product in the downtown core of Toronto has held its own. I mean, it's fallen a little, but it's held its own. The privates were really lending on the periphery, and thus they are the ones who are going to experience the deleveraging. And I'm not sure that government policy had anything to do with that at all. Rather, I think the banks just had better projections, and they said, these are riskier areas for this exact reason. We ain't touching it. And then there are a whole bunch of other people stood in and said, we're ready to take a higher return for a higher risk. And now unfortunately, the risk is coming due. And now that's the reason that they've earned higher interest rates for all those years. But someone's going to take their haircut.
What did you think of the Bank of Canada's decision yesterday to only go 50 basis points?
Didn't understand it. I didn't understand it because again, I'm a huge Canada proponent. I don't want this coming out as me knocking my country. I love Canada. I love this country. I love everything. I love its political systems. I'm engaged, whatever. But
now that you've said that, we're going to edit that out and put it into a TikTok where you crap all over Canada.
Well, listen, part of loving something is calling it for what it is. Like you can't turn to your kid and say you're great at everything. You have to say, listen, this is your weakness, because that's the only way you can work at it, right? Like it's the same thing with Canada. Canada likes to think that it is unique and that it's special and whatever it is, and that we can drive our own force. But the truth is we live next to a southern behemoth, and that southern behemoth drives policy. And we can go our own way here and there around the periphery when things are good, but when they're bad, we hem to the 800-pound gorilla that we are attached to. Powell has not started reducing yet. We, independent of the United States, chose to defy expectations by 25 basis points. The results of that are going to be a lower dollar, because that's what happens. And with the lower dollar comes higher inflation. And if you accept what what Tiff Macklin has been saying about the Bank of Canada, is the fact that that inflation is our number one concern, I don't understand why we've taken so much pain to date. I don't understand why we didn't take the pain of 75 basis points, staying in lockstep with our American counterparts at this time to ensure that inflationary pressures don't return, because if they do, then all the work we've done to date is for naught. It's almost like being on a medication and then reducing it too quickly. I mean, I've been on prednisone. It's a terrible, terrible, terrible drug. But Lord help you if you reduce it too quickly, because then you're going to have to just up the dosage again later on, and you're going to feel even worse. So the goal is take the prescribed medicine and take it slowly. Now, I understand what people are saying. People are saying the pain in Canada is going to be different than the pain in the States, and we have to be cognizant of that. But truthfully, that is a discussion point that we probably should have engaged in during the good times, not the bad. We're now in the bad, and we now just need to take whatever medicine is coming. And I think the medicine called for 0.75. We got 0.5. I'm hopeful that Tiff has better data than I do, and that the Bank of Canada has made a wise, judicious decision. Indeed, they may have. But if what they did was in some way underplay their hand and thus bring back inflation, then we will be paying for it the same way we are paying for the fact that the Feds did not choose to raise interest rates. Remember in 2020 when they said interest rates will remain low for a very long time, and then they did not actually increase it by 0.25 when everyone was expecting that one interest rate? That probably cost us 75 in basis points on the tail end. What we don't do today directly affects how much we then have to do later on. I'm hopeful we made the right decision. I'm anxious about the fact that we did not, particularly given that that's not seemingly where our American friends are. And I think the only thing we can do right now is hem to our American friends. The rest of the world has to as well. No one likes it. No one likes this state of affairs. It's just the reality of the world. And everyone else is being dragged along kicking and screaming. And I don't think we should look at Canada and say we can defy that macro trend.
It's kind of tough to tell people right now. I mean, I was watching the news this morning and I saw that food banks in Toronto are overwhelmed. They've never had to deal with this much demand for people that need help. And the big issues are housing prices or shelter costs, and more specifically food prices, where a lot of people just can't even afford to eat anymore. To sit back and import a bunch of inflation by having a smaller rate hike seems like a tough line to be telling those people that are struggling out there, doesn't it?
Oh, no, it totally is. And by the way, I'm not saying to you that we should be fighting inflation at all costs. I'm saying to you that the Bank of Canada has said that. I'm saying to you that the bank, let's be clear. When you say you're fighting inflation at all costs, what you're doing is you are entrenching inequality in your system. When you keep 2% inflation, although it is painful for those people without money, it is more painful long-term for those people. It's not really painful because they don't really have a lot of pain if you're in the 1% of 1%, but it affects them in a greater sense than it does the person at a food bank. Because if you think about it, let's take an example of a mortgage. If I'm able to lock in for a 5-year rate at 2% or 4 or 3%, and then suddenly inflation rears its head, and suddenly money is worth less 7% every year, then what's happened is I've gone from someone who's very indebted to someone who's significantly less indebted because inflation is there. It allows for the logjam of inequality to be effectively removed. That's what it does. And if you're wondering why it is that every hedge fund and every global investment banker is pledging 2%, it's because it entrenches income inequality. I mean, if you want to be a socialist about this and take a look at this from the perspective of like a left-leaning economist, that's exactly what's going on. I'm not suggesting to you that that's meritorious. I'm not suggesting to you that that's good. I'm not suggesting to you that that's what should be. I am suggesting that that's what the Bank of Canada has said is their priority, 2%. And thus, I'm making assumptions that the Bank of Canada will take action to ensure it's 2%. I am assuming that they have raised interest rates only by 50 bips, specifically because they believe they're going to be meeting their stated objectives of keeping inflation low using 50 bips. And what I'm saying to you is I don't believe that they will meet their metrics of keeping inflation low, or I'm hopeful they will, but who knows if they will. I'm anxious that they won't meet their metrics of keeping inflation low with the 50 bips, which will then necessitate further pain because, again, they have set above all else that inflation target. Should central banks have an inflation target over and above, say, an employment, like maybe the standard that central banks should be using, as they did, by the way, in the 1930s and others, is employment. Maybe they should be setting a metric of base income inequality. Like, you can set different metrics than just inflation, but they've set inflation. They're geared towards inflation. Their actions are taken for inflation, and thus they have set the test. I'm just judging them on the test they've set, and I worry that they're not going to be successful in that test. As to whether or not that should be the criteria and the grading metric and everything else, totally different discussion.
Yeah. And there's a whole side discussion too on really what inflation actually is. And, reporting 6% inflation for the last 2 years when there was points where it was objectively 20%. Now it's probably entering negative territory, and it's still coming up with, what's a 5-6% number. There's lots of other examples I can cite that just sort of make the number, as some people refer to it, as the CP lie. The other thing that I find fascinating about it is whether we're talking about the Fed or the Bank of Canada, they seem really hell-bent on using the annual data. Right? Like we had Joe Biden on 60 Minutes bragging about 0% inflation when the official CPI print that came out like earlier that week was like 9% or something. Like maybe they should be using a little bit more recent data than just what it looks like year over year. I'm assuming that'll happen probably on the back end as they want to start to ease, but they certainly have that card to play, right?
I can't speak to that because I don't know what their data is, but I would be very, very surprised if the Bank of Canada wasn't actively reviewing on a weekly basis what the CPI print is. Like, I get what they're doing. They have a difference between politics and how it appears and what they're saying versus the analysis they're doing. I would hope that our financial institutions like the Bank of Canada and the Fed are actively monitoring.
But if that were the case, wouldn't have they been hiking rates way earlier?
The answer to that is yes. I mean, the answer to that is TIF should have raised rates earlier. So if my proposition holds true, and if they saw what was happening with inflation, then perhaps they should have. Yes. I'm not privy to the data. I can't speak to it. I can tell you that I thought TIF was making a mistake when he was doing it. Twitter is an interesting thing because you can really see where people's positions were as they were going. I was sitting there saying, what the hell? And then I've called for Tiff Macklin to resign many times since as a result of those calls, because it was so obvious to me without any data at all, just living life, that what he was saying was incorrect. What the bank was saying was incorrect. But, as no one has yet nominated me to the Bank of Canada board and I'm not privy to the data, I'm just going to substantially hope that they either are using the data or they've learned from their experience and are now using the data.
So Mark, you've been very generous with your time here. For our audience that wants more of your commentary, where's the best place they can go to?
Well, first off, your audience should know that I love the sound of my voice, so anyone's welcome to call me at any time. Second, and more importantly, for any professionals that are actually on the site, I run, I guess, what is the largest real estate legal Facebook site in Ontario. It's called the Ontario Real Estate Legal Discussion Group for Professionals. You have to be a professional to join it, but we have we're I think at 12,000 closed members at this point, and a lot of detailed analysis goes on there. Most of it is legal questions, by the way, but still, there's quite a bit of macro as well. I'm fairly regular on Daniel Fox Spaces, which I really enjoy. I contribute. I've made a point this year of actually getting involved in Twitter. You can add me on Twitter. I'm Mark and Metaphor, and that would be a pleasure as well. And so I post pretty frequently, and I sometimes, routinely actually, I post analysis pieces. Not for any benefit other than kind of me thinking through an issue, not because these things are widely published. But I do enjoy that as well. And, I'll give you some idea of what's going on in my head, at least, as we kind of go through what is really uncharted territories in the past year and in the upcoming year, for sure.
Well, Mark, thanks so much for doing this. This was really entertaining, and hopefully you'll come back on in the future as we see the real estate market play out here in Canada, which is something that I think everybody is looking for some insightful and thoughtful commentary on.
Totally. Well, look, I'm very grateful for actually having been asked. Thank you for that. And it would be my pleasure to come back anytime.
Awesome. Thanks so much, Mark.
My best.
All right, everybody. Thank you for watching. And if you could do me a big favor, please hit that like button, subscribe, and ring that notification bell so we keep making more of these videos for y'all.